Hello and very good evening to all the attendees who have joined today. My name is Yogesh from Century Financial. I'm a global investment strategist here. Very welcome. Thank you so much for coming. Before even we start this session, I hope everybody is at home, everybody is safe. A big vote of thanks to anyone who is connected to the healthcare sector. A big vote of thanks on behalf of Michael CMC, myself, and my team of Century Financial. A big vote of thanks for to all the doctors, nurses, midwives, first responders. Whatever you're doing, it's great, and I hope that good health comes to your friends and family. Welcome once again. So, guys, we have done this series of webinars from Century Financial a lot. Today, we are bringing someone from CMC Markets live from London, and he will be conducting a webinar. Mr. Michael Houston will be joining us. He's a chief market analyst at CMC Markets, and he holds over 25 years of experience trading the financial markets, specialized in technical analysis, and he's a very well-known face. If you see on financial or mainstream TV, regularly has appeared on BBC, Bloomberg, CNN, CNBC. So his primary focus is on providing technical and fundamental analysis on whatever the daily movements happens in the financial markets. And you will see a lot of seminars he has conducted on trading and financial sector. He has conducted sessions at World Money Show, London Business School, London Stock Exchange, holds an MSTA from UK Society of Technical Analysts, and also a CFDE from International Federation of Technical Analysts. So I would just give you a small request. If you can just go through the session, Michael will have his own explanation. And after the end of the session, please keep writing your questions on the chat. And once the session is over, we'll take 10 minutes to answer the question along with Michael. So Michael, you're next. I'm just going to put my video off.
Thank you for that very generous introduction. Do appreciate it. The purpose, I think, really of this particular webinar is, I think I've been asked an awful lot of questions ever since the market sold off in March as to how much further can we go. And there's been an awful lot of toing and froing, I think, with respect to where the markets could go to next. And we can see that on the S&P 500 chart here that I put up in front of me. Hopefully everybody can see it. What I can't do and what I won't do is tell you where to go long and short the Dow. So those of you who want trading advice, I'm probably not the best person to ask because I get it right as often as I get it wrong. And the question about as to whether should I short the Dow at 23,400 now, I can't really answer that question much as I'd like to. I do think that we are in the process of what I would call a bear market rally. I think there is a good chance we could well have seen the top. And I think one of the reasons why Century asked me to do this particular webinar was because there is an awful lot of toing and froing going on at the moment with respect to not only the big investment banks as to whether or not actually we've seen the base. And certainly there is an awful lot of compelling evidence to suggest that that is certainly a credible argument to make, but I think it is overly optimistic and it is overly simplistic. I think if you go back and you look at the events of the past few weeks, we've seen huge amounts of central bank intervention, not only from the Federal Reserve. We've had emergency rate cuts from the Fed. They've restarted their quantitative easing program. They've embarked upon a stimulus program for Main Street, which is in the region of $2.3 trillion. We've seen huge amounts of fiscal stimulus as well coming out, not only from the Trump administration, a $2 trillion fiscal stimulus program, followed up by another $454 billion, which is due to be signed off at the end of this week. We've got the European Central Bank embarking on a pandemic emergency asset purchase program of 750 billion euros. Germany is embarking on a 750 billion euro fiscal stimulus. And then you've got the UK. Emergency rate cuts from the Bank of England. The Bank of England has also suggested that it may well support UK government spending as part of its ways and means program, which could see it indirectly, I think, financing the UK government spending plans. Rishi Sunak, the Chancellor of the Exchequer, has embarked upon a £330 billion stimulus program to support wages up to 80% by the end of June. That's around about 13-14% of UK GDP. Wherever you look, governments are spending money to ride out the after effects of this pandemic. Central banks are printing money like it's going out of fashion. You've got this chief investment officer of BlackRock saying that ultimately, don't fight the Fed. Whatever the Fed's buying, we're buying. The Fed is also going into junk bonds. They're saying that they're going to buy the bonds for companies like Ford Motor Company, which have been downgraded to junk, which on the face of it, when you say the Fed is buying junk bonds, well, surely that's just a license to print money and buy stocks. And if you frame it in those terms, then I certainly think there is a case for that, except it ignores one significant fact. And the fact of the matter is, if you look at the economic data that's been coming out across the globe, it's been undeniably terrible. And for me, you've got the fiscal stimulus and the monetary policy stimulus on the one hand, but you've got it coming up against the economic data on the other. And whatever you say about stock market valuations, the fact that bond yields are collapsing, ultimately companies still need to make profits. They still need to make money. They still need to have some sort of value in terms of their business model. And certainly there have been some winners and losers in the context of the decline that we've seen from these highs. I've drawn some very key levels on the chart that you're looking at in front of you right there. And as you can see, the moves that we've seen since the 17th of February almost dwarf the price action that you've sort of seen on the slow move higher. If I actually zoom this chart in here like so, you can see how much volatility we've seen in the space of the last 2 months. It's been utterly incredible. It's been a long, long time since we've seen volatility of the kind that we've been seeing in the past 2 months. And that makes investing and trading very, very difficult. And this is where, for me, technical analysis helps. Now, it's certainly not a panacea. It's not a silver bullet. But what it does do is it allows you to adopt rules and certain elements of discipline, I think, to your risk management processes. So you can argue that there's a compelling case for the bull market to return, but you can also make a case as to why I don't think we're going to see new all-time highs in the S&P 500, despite what investment banks like Goldman Sachs and investment managers like BlackRock are telling you. One of the key things that I've taken away in my 25 to 30 year career in financial markets is trying to sift through the cacophony of noise, news, and everything else, and try and actually make up my own mind about where I think markets are going. Because I think if you're a money manager, you can see the flow, and the flow tells you it gives you a good indication of where all the money's going and where the markets are trading. And I think for me, that is a fairly decent indicator of where the market is going. But it also tells you that the dumb money is going there as well. And there are different stages of any move higher or any move lower. And that's why I always like to try and strip it back to basics. Back to basics for me, it's Dow theory. And I know it's old and it's traditional, but I'm the wrong side of 50, so I think I'm entitled to take a slightly old-fashioned view when it comes to technical analysis. And for me, it's really what works. And different people will have different ideas of what works and what doesn't. And what works for me may not work for you guys over there. So there has been a big tug of war, absolutely, as someone has just pointed out on the chat here, between the bulls and the bears. For me, it's about, can we avoid a recession? Well, no, I don't think we can. In fact, I think it's likely that we could get a depression if policymakers mishandle this particular crisis, and it is a crisis. You know, who could have foreseen a pandemic and the policy response to that pandemic? It's unlike anything I've ever seen. I've seen the market crash of 1987. I was sitting at a trading desk on Black Wednesday in 1993 when the pound left the European exchange rate mechanism. We've had the dot-com bust. We've had Enron. We've had the Asian financial crisis. We've had 9/11. We've had the UK. We've had the US, the financial crisis of 2008. We've seen the big sell-offs at the end of 2015 and at the end of 2018. Nothing on that scale as matches to what's happened in the past 2 or 3 weeks. We've seen an incredible down move, and we've seen an incredible bounce back. So I think for me, it's really about what the price action is telling me. I don't think we're going to get a V-shaped recovery. Certainly the data doesn't support that. And we haven't even got to see how bad the data is yet. But certainly early indications would give you an indication that 22 million Americans have filed for jobless claims in the last 4 weeks. Tomorrow, we could well find out that there's another 5 million to add to that roll of woe, if you like, because 27 million people in the space of 4 weeks, that is a heart attack for the US economy. And that's really reflected in how US policymakers have responded. That's really reflected in how the Federal Reserve has responded. But will it get us over the hump? I think the big question really is how long or how soon can these lockdowns get lifted? And even if they are lifted, will life go back to normal? I think we all know the answer to that. It won't go back to normal because these lockdowns are going to be with us in some shape or form for quite some time to come. Until there is a vaccine, until there is some sort of testing strategy, life is not going to return to normal. So what does that mean for your money? Well, one of the things that I've noticed, and I know I'm talking a lot at the moment, and I know you probably want me to go through the charts, but we've got at least another half hour. So there's plenty of time for me to do charts and technical analysis and what have you. One of the key indicators for me is that if we're going to get a decent rebound in equity markets, then I would expect to see gold weaken significantly. We're not seeing that. And more importantly, what the oil price is doing tells me that the underpinnings of the global economy are on very, very shaky ground. Now, you can put some of the volatility in the crude oil market down to the price war between the Saudis and the Russians and their desire to put the US shale industry out of business, or at least cause significant damage to them. But I can't really see President Trump going for that. And he's already talking about some sort of package to bail out the shale industry. And let's not forget, it's an election year for the president, assuming the election takes place. But it will take place, whether it takes place in November or whether it gets deferred. Whether they actually can defer it is also another big question with respect to the US Constitution. It's due to take place at the beginning of November. Well, I don't think that life will return to normal. And what will the new world that we're going to be seeing as we come out the other side of this, what will this mean for airlines? They're already implementing a massive bailout for airlines. Will people travel in the same way in 6 months' time that they were traveling 6 months ago? 6 months ago, just over 6 months ago, I was in Dubai with you guys hosting or being invited to an event over there. Is it likely that people will want to get in planes or get on planes when social distancing measures are still very much in place, and they're likely to be in place for quite some time to come? You can talk about social distancing measures in the round in the context of, well, you can leave gaps between rows, but you're still breathing the same air on those planes. So who is going to feel compelled to get on an aeroplane with a host of 200-300 other people when there is no vaccine and there's no guarantee that you won't get reinfected by this virus? You may have it once, but the World Health Organization have suggested that that's no guarantee that you won't catch it again. So there's a whole host of different things that you need to weigh up. So for me, the price action is the most important part of the equation, because what that does is it strips out all the noise, and that's one of the key pillars that I base all of my analysis on. History usually repeats itself, and if it doesn't, it often rhymes. So it may sound a bit of a cliche, but ultimately that's all you've got to go with, because for me, the central bank put has meant that fundamentals are of much less value than they were, say, for example, 10 years ago. You can have companies that don't make a profit, are not likely to make a profit, being launched on the stock market for multi-billion dollar valuations. I can give you one example: Uber. Uber, classic case in point, launched to much fanfare just under a year ago at a $70 billion valuation. $70, I think it was, something in those sorts of regions, $70 a share. Well, it's on the bottom right-hand corner down here, Uber, and it's now $27 a share. So that gives you an indication of valuations, or how much people perceive a valuation currently is. So I think for me, the world is going to be badly hit by a recession. Now, that doesn't mean that stock markets are certainly going to come crashing off. But I think what it does mean is that you're going to have to be much more discerning about the type of company that you put your money in. So, airlines are probably, for me, a little bit of a no-no, given the fact that we don't really know how they're going to be able to adapt their business model for this new normal as we come out the other side. So will that mean higher fares and fewer flights? What will that mean for the unemployment rate in their respective countries? Because will they be able to maintain the same staffing levels that they did before the crisis, after the crisis? So, and that applies pretty much across the entire spectrum for not only manufacturing, but services as well. Because one of the key things that I think an awful lot of people will be able to take away from this crisis is how people have been able to adapt to working from home, like I am right now. I'm in my home office down on the south coast of England, with the beach 5 minutes away, with a camera on my left here, a webcam here, and a Bloomberg on my right. And I can do my job just as easily from my own tiny office down here on the south coast as I can from the City of London. Of course, what it doesn't substitute for is face-to-face contact, or the banter that you have with your colleagues in the office. There's no substitute for that. But I certainly think the way people work is going to be much different to the way that it was in January this year. So in January next year, we could be working in a completely different fashion, where technology really, I think, drives innovation. And certainly in the context of certain stocks, then I think there are certain stocks where you really do need to think that there's potential for fairly decent gains, even at the valuations that we're currently seeing. So companies like Microsoft, companies like Intel, AMD, people that make chipsets and what have you, or graphics cards and what have you, they could do well. But the big question is, how do you diversify that risk at a time when you could have one company that's doing very, very well, but you could have another company that's probably not doing as well? So I'll give you an example in terms of Netflix. If we look at Netflix have done really well in terms of streaming. And yet, if we look at this chart here, ladies and gentlemen, or this popular stocks watch list that I've got here, it's the only one that's actually got a red arrow next to it, down 3% today. And why is that? Well, let's just quickly close my S&P chart and let's talk about Netflix, because I have a Netflix subscription, as I'm sure an awful lot of you people do as well. But I would argue that an awful lot of the good news on Netflix is already priced in. And we can see that in this particular chart here. I've already circled it. What we've got here is an awful lot of choppiness at these highs that we're currently seeing at the moment. So if I was looking to trade that, for example, and thinking that, there's potential for this particular stock to have run its course for the time being, they added 15.8 million new subscribers in Q1. The biggest problem that Netflix has got is that, okay, their content pipeline is paused at the moment, and they are the most expensive streaming provider out there. How much of that is already priced into the price for Netflix? Let's zoom out and see where we go here. Look at this. Netflix is at all-time highs. So even though it's done really well and is outperformed after breaking above this series of all-time highs here, because that was the previous set of all-time highs here. So I'm going to draw in a little line here just to highlight that particular point. There we go. So around about $392. Even though we've broken above that, it does appear to be finding a bit of a top around about $450. We can see that here by zooming in. So purely on a technical basis, and purely looking on the fact that this slow stochastic here, which I use to plot overbought, oversold, but also potential divergence, on that basis, any move back to 434.40 will be a decent possibility to sell Netflix with a stop loss above the previous highs. Yes, it is in an uptrend, but it's had two goes at this level here, and thus far it's failed to capitalize on a move higher. And one of the key takeaways that I took from Netflix's results yesterday was the fact that even though they doubled the number of subscribers they were expecting to get in Q1, they still missed on profits. Revenues were only ever so slightly higher. So they're spending an awful lot more on marketing spend, and that's eating into their bottom line. They're also spending an awful lot on content. And you can certainly argue that they are the market leader, but is that market leader already priced in? So, on a short-term basis, and this is a short-term basis, if I was looking to get into Netflix, I wouldn't be buying it here. I'd be looking to pick it back up down around these sorts of levels down here, because it's too expensive. An awful lot of the good news is priced in. We've got Apple TV Plus, we've got Disney Plus coming online, both of which are cheaper. Yeah, the content's not anywhere near as good, and certainly not anywhere near as comprehensive, but nonetheless, if you look at it in the context of the pockets that Apple and Disney have with respect to how much money they can throw at content, they can afford to give it away. Netflix can't, because Netflix doesn't have another income stream. Apple does. It's just launched, or in the process of launching, a new iPhone. Services revenue has increased quite significantly for Apple over the course of the past 6 months, and only likely to get bigger as they promote Apple TV Plus. Personally, I don't like Apple TV Plus that much, and I don't like Disney that much, because there's not that much in the way of content. I much prefer Netflix, I much prefer Amazon Prime. So it's going to take something quite substantive to get me to swap those two subscriptions for, say, for example, Disney Plus or Apple TV Plus. That's not to say it won't happen, but it's probably not going to happen quite yet. So Netflix is probably going to maintain itself position as the market leader for quite some time to come, until such times as there's clear evidence that Apple TV and Disney are starting to make inroads into market share. Now, what could cause that slowdown in subscriber numbers for Netflix? Well, it's quite simple: unemployment. If you're unemployed and you've got a load of subscriptions, which ones are you going to cut first? You're not going to cut your cable. You might cut your cable, but you also might cut your discretionaries like Netflix or Amazon. So the economic outlook will play a decent part in where this goes to next. But at the moment, on a daily chart, we do look a little bit what I would call uncertain with respect to where we are at the moment. So let's see if we can get a different idea from the candlestick chart. The candlestick chart is not particularly instructive. We certainly made a decent high here again, but we haven't taken it out. So what this is telling me is that this move higher in Netflix is probably a little bit too rich for me at the moment. That's not to say that I wouldn't be interested in it at some point in the future, but I'm certainly not buying it here. But would be looking to maybe get in to sell it on any move towards 450 with a stop loss at around 460, 470 for a potential move lower. I'm just going to quickly have a quick shifty at the chat because I don't want to miss any questions with respect to where we're going to go to now. So, all being hit by recession. Someone wants me to look at oil. Okay, well, that's certainly been a widowmaker trade over the course of the past few days. It's not really made too many friends. Looking at the Brent crude cash contract, if you want to diversify your risk in terms of Brent crude or the energy complex, there is an energy index that you can avail yourself of, which helps to diversify your risk in this particular sector. But in terms of where we are at the moment, you may notice on Brent, we've got a horizontal line down the bottom here on this particular cash contract. Now, I drew that in quite deliberately, going all the way back to 1999, 2000. So on a monthly basis, this level here around about $16 a barrel on the cash contract, it's a very, very key level. So on a technical basis, on a monthly chart for Brent crude, I'm not a seller. I'm not a seller at these levels. It's unbelievably cheap. Now, that doesn't necessarily mean that it can't go any lower. Given the volatility that we've seen over the course of the past 4 weeks, it can fall another $5, $10, $15 quite easily. But it's where it finishes the month in terms of this candle chart that I'm most particularly interested in. I think when you're looking at Brent on such a short-term time horizon, it's very, very difficult to really say with any degree of certainty where it's going. I got to say, I'm very surprised that we've fallen as far as we have, given the pain threshold for Saudis and generally oil producers in general. But I'm guessing they're taking the view that their pain is probably bearable when compared to the pain of US shale producers. And I think it's unlikely that oil prices are going to rally significantly higher until we get a clearer idea of when demand is going to pick up. We've got a supply glut. We've got a supply glut that's not going to go away anytime soon until those pumps stop pumping. Because if I try and extrapolate when demand is likely to pick up, for me, it's not going to pick up significantly for at least another 4 or 5 weeks, simply because that's when the lockdown procedures are likely to get relaxed a little. Yes, freight is still being transported, so that means that demand is there. And you've got US driving season, which is due to start in May, June. But again, that's down to the US drivers' desire to go on holiday with respect to driving season. And that for me, I think will be a big determinant of how much demand there is in the US. But demand is not going to pick up the slack to the extent that we're going to see a rally back to $40 a barrel within the next 2 to 3 months. We may see that in 2021 because oil companies have cut capex and demand starts to pick up again. But at the moment, storage at Cushing is full or pre-booked as being full. Storage in India is pretty much at its limits as well. So that storage capacity needs to be run down. And at the moment, it doesn't look likely that's going to happen anytime soon. So at the moment for Brent, even though we are near multi-year lows, it's very, very hard to make a case for a significant rebound at the moment, which means that ultimately what you've got to do is try and play the range. Well, we don't even know what the range is because we haven't really set into one. We've just broken out of one where the top of that range was around about $32 a barrel, but we're now pretty much just under half that. So the big question for me is where do we go from any rebound in Brent crude or WTI? And for me, that's as much about geopolitics than it is about any technical analysis. So in terms of oil, that's something that really is a little bit too rich for my blood, because you need a hell of a lot of margin, and you've also got to factor in holding costs as well, and they are going to become much more expensive the more volatile the contract gets. So Brent crude at the moment, I think there's potential for another thrust lower, and unless we get production stops, then we could well go to $10 a barrel, because the only thing that's going to stop this oil price going lower is if US producers stop producing or OPEC turns the taps off. And the risks of turning the taps off are quite high because it's very, very difficult to turn them back on again once you turn them off. But I fear that's the only way that you're going to stop further declines in crude oil prices over the short to medium term. So in terms of where we are at the moment, Brent is very much a sell on the rally. The big problem I have is identifying where the top of any rebound is likely to be. So let's try and drill down into that if we can. Try and look at, say, for example, maybe 4-hour charts to see whether or not there are areas of congestion where rebounds sort of run out of steam. And I'm looking at the 2-hour chart on Brent, and we can see from going all the way back to the 15th and 16th of April, there was a decent area of support going all the way through this series of lows through here. And this is what I generally tend to do when I start to look at these types of charts. If I can't see anything on the daily, I'll look at the 4-hourly or the 2-hourly and look for areas where the market's found support or resistance. So let's do this one here. And this is around about $25 a barrel. It's had several goes at it over the course of the past few days. Once it finally broke below it, it acted as support, it acted as resistance on the impulse move back before finally dropping lower. It may sound very simple in terms of the overall analysis, but to me, technical analysis is a very simple subject. You work on the basis of what's the market doing? Is the price going up, down, or sideways? Has it broken out a series of resistance levels through here? It has, because I've just noticed these here. There was a series of highs through here and here and here. We've broken through there, and it's triggered a whole load of stops all the way through $20 a barrel, all the way up to almost 22. So if we get a pullback, we could find a little bit of buying interest around about the levels that we are now, or just at the low of this particular 2-hour candle. You look at what the price is doing. You look at where the buyers and the sellers are coming back in just on the basis of the price action. Because for me, the price is the most important piece of information. You then look at what it's done in the past, look at where the areas of the support and resistance were, and then you trade on that basis. So I think the fact that if we're able to stay above the lows of this particular candle, which is around about $19.60, then we could well see a retest of $22 a barrel over the course of the next 2 to 3 hours. But again, that's a bit of that's quite a big call to make, simply because you've probably got quite a few stale short positions down here that are starting to sweat a little bit because of this real strong impulsive move higher that we've seen in the Brent price. So that's generally how I try and break down a trade if I'm looking for an opportunity to get into the market. So that's looking at the Brent price. I'm looking now, I've been asked about Tesla. Okay, give me a minute. Because I'm working my way down the questions here, ladies and gents, so please bear with me. So I got asked about crude. Now I'm going to move on to gold. So I'm going to go in order. So if I don't get to you, don't fret. There'll also be some time at the end of the presentation for a few questions. I mean, personally, I'm bullish on gold. Given the current circumstances and the global economy, you can't afford to not be bullish on gold. Now, you can argue that gold is an inflation hedge, and there isn't any, but it's also a safe haven. But I do think that we could well see some inflation in 2021. You think about the amount of stimulus, you think about the amount of money that governments and central banks are throwing at the economy. Now, at the moment, all it's doing is it's keeping the economy above waterline. It's stopping the economy from sinking. It's in stasis. So that money is just basically there keeping the market afloat. But at some point, once we come out the other side, and we will, there'll have to be significant discussions about debt jubilees, debt write-offs, and what have you, because at the moment, this crisis has come when an awful lot of European and emerging market economies have an awful lot of debt. Europe being a classic case in point. It's one of the key concerns that I have about this particular rally, particularly in Europe. European leaders are meeting tomorrow to talk about a European recovery fund. And at the moment, there's a big split between North and South about who pays for it. The North want there to be loans, or loans on top of debt already. That's a big problem. And that's before you even consider the banking system in Europe, which still isn't fixed. You've had US banks last week setting aside up to $25 billion in respect of credit losses. You've got UK banks potentially going to be doing the same thing next week because of the big rise in unemployment that's coming our way down the pipe. We don't know how big it is, but it's probably going to jump by about 2 million people in the UK. It's already jumped by nearly 25 million people in the US. That's going to mean an awful lot of defaults on car loans, on credit card loans, on mortgage loans, which banks are going to have to absorb. And that's before you even start to talk about the US banking sector's exposure to US shale. So you may find that the government bails them out in that regard, but certainly US banks have got a debt tsunami coming their way. And if they've got a debt tsunami coming their way, so have European banks who haven't dealt with the last debt tsunami of the Eurozone debt crisis. So there's an awful lot of debt out there, which will at some point need to be addressed. But going back to gold very much in an uptrend on the daily chart. My target for gold at the end of this year is $1,800 an ounce. That was my target in January. It remains my target. I think we will get there. In fact, we could get there sooner than that. But that's my target for the end of the year. I'm sticking to that. What might undermine that? Big declines in further declines in oil prices, or a big sell-off in stock markets as people have to cover margin calls. We certainly saw that in March, where gold prices sold off as investors piled into cash to cover big margin calls or cover losses in their stock market portfolios. So certainly gold could feel the effects of a sell-off there. But overall, I think if we see a pullback to around $1,650 or $1,600 an ounce, then I think you've got to be a buyer of gold. So very much a buyer of dips on gold. I think you have to be in times like these, whatever currency you're in. Gold's definitely much a buy the dip. Moving on to Tesla. Do I have any views on Tesla? Yeah, well, I think it's overpriced. Certainly not worth the valuation that's currently assigned to it. But you can't stand in front of a runaway train. And that's what we had earlier this year. But let's look at the volatility in Tesla. It does look a little bit overbought. And for me, it's certainly not something that I would be investing in. And certainly seeing the size of the sell-off that we saw from the February highs to the lows that we saw in March gives you an indication of the type of volatility. The stock dropped 2/3 of its value in the space of 2 weeks. And now it's rebounded just as much. We've got earnings from Tesla next week. Now, the likelihood is they're going to miss on pretty much every single measure, simply because they're not producing any cars at the moment, and they're due to restart production at the beginning of May. So I think the big question for me is, yes, renewables is probably going to be a much bigger discussion for 2020 and 2021. And that's why I am also overly cautious about the crude oil sector, because I think big oil is likely to find it much more difficult to maintain its payouts. And by big oil, I'm talking Royal Dutch Shell, ExxonMobil, Chevron, the big US multinationals, the big UK multinationals, at a time when oil consumption is likely to be much lower than it was, say, for example, a year ago. There's going to be a big push for renewables. At the moment, oil is cheap. So you may find that you get a nice, decent bounce back in consumption. But that consumption also needs to be set against the fact that, are people going to be more inclined to travel or less inclined to travel? So you'll get a rebound, but will you get a V-shaped rebound? I don't think you will. So I think you're going to have to temper your expectations about oil majors and their ability to generate cash. Certainly some are stronger than others. BP I'm a little bit cautious of, simply because of its gearing and the fact that it's very exposed to the US shale sector, and the fact that it has a dividend yield of about 12%, which is probably not sustainable at current valuations. Looking at Tesla, though, I think there's potential that it looks a little bit toppy. If we look at this candle chart here, and I like using candlestick charts because they're very instructive in terms of how they actually, the overall look and feel. But certainly I think in terms of $800 and this series of highs through here, if I draw a line through these highs, just bear with me a second, ladies and gents, we can see that apart from a brief couple of islands of price action, it hasn't really been able to sustain a significant move above them. So in terms, if I change that to a candle chart, I think it's much more instructive. There's only been 1 week of price action where we've seen a move above $820 an ounce. Now, on the candle chart, it does look as if it's about to turn higher. And we did bounce off the 50-week moving average on the move lower. But I think you've got to take into account what future demand is going to be like for Tesla motor vehicles over the course of the next 12 months. In recent months, they have broken all records when it comes to deliveries and production. How likely is it that they will be able to maintain the pace of deliveries in the aftermath of this particular crisis? Are we going to have to revise down our expectations for the auto sector? And I think that's the key for me. What's demand out of China likely to be like as we head into the back end of this year? And I'm not convinced that it's going to be anywhere near as robust as it was at the end of last year. Tesla have just opened a big factory in China, which they've had to furlough, shut down. They may bring that back online, and I think there is some talk that they may have restarted production on a tentative basis. They've still got to shift that product. So again, I think it's a little too early to say with any degree of certainty where we go to next and whether or not we revisit these all-time highs. Also, if we look at what markets are doing, and I think it's instructive if we look at the S&P 500. I'll talk about palladium in a minute. But if we look at what the S&P 500 is doing, momentum at the moment is clearly towards the downside. If we look at the 50-day moving average, we look at the 200-day moving average, and we look at the price action and the way the market's behaved, we can see quite clearly here that it's going to be very difficult for us to move through 29.34. If we look at this move lower here, we've retraced just short of 61.8 Fibonacci retracement level. So for me, unless or until we go back above the 200-day moving average or the 50-day starts to flatten out, then I think the potential for a significant rebound for these levels is limited, simply because of the direction and the momentum that's currently being shown by the moving averages and the impulsive nature of this move here. Now, looking at the daily chart, we got a nice bullish reversal there. We got a little bit of a break higher, weren't able to sustain those moves. We're retesting the highs here. If we look at the weekly candle here, again, this is just basic technical analysis and charting. We can see here that, I mean, there's a massive gap here as well. There's a massive gap. So we may find a little bit of support in and around 26.50, but I would expect to see a return to this gap here. We need to fill this gap. So at the moment, we're probably going to be trading in a range. There's quite a big range, this. We can see that. We can see it from this chart here. If I just highlight it there, we can see that. We go down. If you look in the top left-hand corner of the chart, you can see open, high, low, close. So there's quite a big range, 28.84, 27.26. If we look at the candle next to it, 28.93, 27.20. So there's quite a big range there to play with. So in the context of where we are at the moment, I'm still very much seller on rally on the S&P 500 until such times as we're able to take out that fib level at 2,900, there or thereabouts, and the 200-day moving average, because that's looking like a significant barrier. What's also important, I think, in the context of this is to look at all of these indices in the round, so not just the S&P, but also the Dow, and where we are at the moment. So we'll just get this chart to open. And it's amazing how similar it looks to the S&P. What is instructive, though, is that the 50-day moving average is actually capping the gains in the Dow here. And these highs here are around about 24,450. So again, we're below the 50-day moving average on both, and we're below the previous highs. So until such times as we take these peaks out, I'm very, very reluctant to be anything other than a sell the rally type of merchant when it comes to the S&P. Let's look at the DAX, because the DAX and the S&P and the Dow, they do tend to move in fairly decent lockstep with each other, not to the same extent. The S&P and the Dow have outperformed the DAX by quite some distance, but look at the moving averages again, ladies and gentlemen, in terms of where we are at the moment. And we can see here. The only difference here is that the DAX is stalled at the 50% retracement level of the entire down move, and it's finding support on the 38.2 here. So you've got 10,200 on the downside, acting as decent support on the DAX, but on the upside, you've got 10,900 or 10,880 acting as resistance. So again, you're playing a little bit of a range trade here, but while we're below these highs here, then I think it's more likely we will break lower and come back towards these highs, but we will probably do it all at once, i.e. if the S&P does it, then the DAX needs to do it and the Dow needs to do it. They need to move in lockstep with each other. Let's look at the Nikkei, and I have a feeling you will probably find a similar sort of relationship. And again with the Nikkei, nice little barrier around about 20,000, but also through these series of highs through here. So you've got a great correlation between the Nikkei, the DAX, the S&P, and the Dow. And when you get a break higher or lower, what I want to see is corresponding breaks higher or lower in all of these to establish whether or not we've got a false break. Now, I've been asked about silver relative to gold, and I've got to say, you know, silver, the outlook for silver and palladium is muddied by the fact that they are industrial metals as well as precious metals. So you've really got to separate them, which means that demand for silver and palladium is likely to be much less if people are producing, or motor manufacturers and industry needs the component parts for putting in motor vehicles. So if we look at silver, being a case in point here, we can see straight away that silver is reacting pretty much in the same way as equity markets. It's following the move in equity markets, which suggests to me that it's a risk play and not haven play. So you would expect gold to appreciate relative to silver much more. So I'd expect that relationship between gold and silver to move in gold's favour. And the same would apply with respect to palladium, because again, it's an industrial metal. Having said that, palladium has a habit of not behaving rationally. But here we've seen some significant moves lower in palladium. And again, they appear to be, particularly recently, being matched by a little bit of consolidation in equity markets. But you've got to take it in the context of where's the demand for palladium going to come from at a time when the global economy is in recession. So you could argue that palladium, platinum, silver play the sort of role that copper used to play in terms of it's more a barometer of the economic activity within the global economy. So hopefully that asks your questions. Now, someone's just said gold to touch $3,000 in 18 months as per Bank of America. Yeah, it's possible, or it's just possible they just want to get on the telly. And I think that sort of quote does sort of guarantee you a slot on CNBC or Bloomberg. You know, if you want to get yourself on the telly, come out with an outlandish, prediction. It works for me. So I've said that stocks might go up when gold drops. Well, that's basically because money comes out of gold and goes into stock markets because gold doesn't have a yield, whereas stocks generally do. So what will happen is that people will liquidate their gold because they think the risk premium has diminished, and they'll put their money back into stock markets. That's the only correlation that I would draw from that. Will USO go bust? I have no idea, is the honest answer to that particular question. Right, I'm getting some currencies questions now. So with respect to the S&P 500 over the next few weeks, I think I've already said I'm very much a sell the rally while it's below the S&P, while it's below the 200-day moving average. And in the short term, I won't make a prediction other than I think there's a potential for it to retest the lows. Simply because I think if you try and extrapolate anything beyond that, it's very, very difficult to do. Euro dollar, it's pretty much watching, like trying to watch paint dry. There's certainly, I think, decent support around about 107.80, and I'm going to draw that in for you there, right there. So let me just put that back on again. Don't know why that went. Let's get rid of that. Let's store that. There we go. So at the moment, what euro dollar's telling me is that we are poised to go lower. Why do I say that? Because every single rebound that we've seen off these lows here has been shallower. So we've got lower high, lower high, lower high. So if we take out the support that's around 107.80, 107.60, then we'll look to retest the lows that we saw at the beginning or the end of March at around about 106.30. So again, with euro dollar, I'm very much sell rally on euro dollar. Looking at what else we've got. Hopefully I've answered your questions on gold. I'm scrolling up. It's my take on cable. Yeah, I mean, cable's a tricky one because it gets buffeted by euro sterling quite a lot. And I still fancy euro sterling to go lower. I think I'm more of a sterling bull against the euro than I am against the dollar. But let's look for the sake of argument at against the euro for sterling dollar at the moment, or cable, as I like to call it. 50-day moving average, decent resistance. At the moment, there's decent support in and around this low here. So if we look here, we've got 121.65 on that low there. Let me just drop that stochastic back in. because I hit it by mistake. And get rid of that. So I think cable's very much a range trade. Obviously, a stronger dollar is going to hurt it, but I think as long as we stay above 121.65, then I think we can return towards 124, 125. Now there was a technical analysis report out earlier today saying that we've seen a death cross on the moving average. It was 50 crossing the 200-day. I'm not overly concerned about that simply because the trending cable at the moment is not particularly easily definable, and the golden cross that we saw in early December didn't really amount to much apart from a move up to 135. So if a golden cross isn't going to work particularly well, I'm not inclined to think a death cross will either. And even if we do, there's really, really strong support in and around 119.80. I mean, we did go as low as 114, but we didn't close the month below 119.80, and that for me, I think, was a very, very key level for me on the cable. If we take it out all the way to the monthly chart, and I know we're already 1 hour in, and I'm very cognizant of the time, and I'm sure Yogesh will tell me to get a shift on because there's an awful lot to get through. We didn't close above the 119 area, which coincides with these August and October 2016 lows. So for me, we got what I would call was a bit of a bear squeeze out in the cable in March. And as long as we don't close below 120, then I'm probably thinking that we're probably more at risk of going to 130 than we are to 120. But again, once you throw Brexit into the mix, then all that goes up into the air. But all you can do is trade what you see. And that's all I do. I trade what I see. And if what I see is telling me completely contrarian to what the big investment banks are telling me, then I will go with my gut because it's my money. It's not theirs. It's mine. And I've always been a little bit suspicious of investment banks because generally I think they're talking their book or they're trying to talk the market up so they can sell out their holdings higher up. That's just me being cynical a little bit. But, you know, it sort of broadly makes the point. Now, someone's asked me about sterling Aussie, so let's have a quick look at that. So I'll go into the library and we'll type in sterling Aussie. Here we are. Here we go. It's just taking its time a little bit while it searches through the entire database. And there we go. Sterling Aussie. Right, so let's just do that and open the chart. Now, in terms of before I finish up here, ladies and gents, I want to talk to you a little bit about some new products that are coming out or have come out. We've got a series of baskets which are due to be released in the coming days, and you may have seen them in my list here. It's a streaming basket. What this streaming baskets and all these baskets allow you to do is to diversify your risk in terms of your exposure to a particular sector. So, but they can also give you an underlying picture of how a particular sector is performing. So this is a streaming basket. Streaming basket's got Apple, Netflix, Disney, and a whole, trying to think what else, Amazon in them. And there will be details about how the makeup of these baskets is laid out, which I'm sure the guys at Century will outline to you. But what these allow you to do is to diversify your risk in a particular way, either long or short, if you're a bit concerned about big rises or falls in the market and you want to try and hedge that exposure. So we've got a streaming basket there. We've got a big tech basket. We've got US banks baskets here as well. So we've got US banks here. And we can look at that. And we've seen a nice rebound there, but again, you've got decent resistance on the top part around about 2,800. It is in a little bit of an uptrend here over the short to medium term, so you can potentially draw a line through that. Works in exactly the same way, and they're quite useful. And then we've got currency indexes. So we've got a CMC dollar index there, which basically is similar to the US dollar index. The only one of the main differences is, though, that Chinese yuan has a much bigger weighting in it than the euro. So it doesn't move in the same way as the dollar index. The yuan and the euro have equal weighting in this particular index, whereas in the dollar index, the Chinese yuan isn't even in it. But it's a trade-weighted index, and the US does a great deal of trade with China. Therefore, the yuan needs to be in there. We've also got a CMC sterling index and a CMC euro index. Again, the guys at Century will outline the details as to how you can use those indices to potentially hedge any currency risk that you might have. So just going to finish up with sterling Aussie. I'm just going to make the font bigger for those of you, or like myself, who probably need a little bit of help with the numbers and actually seeing them. So you can do that quite easily. Go done. There we go. So sterling Aussie looks a little bit on the soft side. You can see that from here. And it's near some fairly key support around about 190, 193, 192. A series of lows through here. Could be starting to build a little bit of a top with the Aussie rebounding relative to the pound. But at the moment, it looks a little bit toppy on the price action. If we break below these lows here, then I think there's a good chance we could see a little bit of a move lower. If we break it out, it's come an awful long way in a very short space of time. So let's try and draw a trend line on it. And this is essentially, you've asked me a question completely out of the blue, and this is generally how I tend to break it down. I'll look at the price action, look at the overall trend from, say, for example, here, draw a line through there, try and get an indication of where we are. Bit of accuracy. So we're in a bit of we're on trend line support from the lows last August. So we could get a little bit of a rebound from here. But if we break below here and through 190, then we could see quite a rapid sell-off on the daily chart. So I'm just going to take that back down to daily again. And there we are, rescaled to there. Right, let's have a look at, what about European banks? Well, a proxy for European banks is Deutsche Bank. And I've got to be honest with you, I'm not optimistic about European banks. On the basis of the discussion that I had earlier about the non-performing loans. So if we look at Deutsche Bank, we've seen a decent rebound, but if we look at the European Banking Index, which I'd hoped to show you, but unfortunately I had to close my Bloomberg because it was slowing my system down, I'm very much sell the banks on any rallies in Europe, because UniCredit this morning set aside 900 million euros in respect of non-performing loans for the next quarter. I can't think that other European banks won't do the same things. So European banks for me are very much something that I would steer clear of in terms of looking to get long of them. Certainly if I was looking to trade them, I'd be looking to sell the rally on any move on Deutsche Bank's share price to $7 a share. I'm really not optimistic about the European banking sector going forward. To day trade, really day trading is, I mean, I'm a currency trader. I day trade currencies. So, you know, for me, if I'm day trading, I'm trading things that you know. So I know currencies. I traded currencies for 5 years. Traded cable, dollar yen, dollar mark, euro sterling, you know, and all of those sorts of things. For me, currencies is what I know. So for me, and for you, ladies and gentlemen, trade something that you're familiar with, that you understand how it works, that you're able to understand the risk, and that you're able to absorb any losses, because you will make losses. We all do. You get squeezed out of a long position, you get squeezed out of a short position. I got squeezed out of a cable long position only a few weeks ago on the move up to 125. I missed the bottom by 15 points on my stop loss. I was annoyed about it. I had the right view, but my stop was in the wrong place. It happens. Okay, Sarah, Sarah. You know, these sorts of things happen. But trade what you know, I think, is probably the best advice I can probably give you when it comes to trading any particular asset class. I just noticed someone has asked me about Aussie dollar, so I'll quickly cover that for you because I don't want to be accused of missing anybody out. So I'm just going to do that now. Open that chart because I had that saved already. And here we are. I can't help thinking that looks very familiar to the S&P chart or the index charts. Very much a risk play, Aussie dollar at the moment. So if we get a sell-off in equity markets, then I think it stands to reason, given the fact that if we take out this low here at 62.50, so if we break below 62.50, I think there's a good chance we could go lower. What's also interesting here is we had a bearish key day reversal on the daily charts, which would suggest that we've probably seen the top. So we'd look to probably sell any rallies towards 63.80, 64 for a move down towards 61 and 60. If we break that down into slightly more detail on a 2-hour chart, we can see that there's a decent area of support all the way through here. But the lows, while the lows are pretty constant, the highs are starting to run out of steam a little bit. You've got a high there, you've got a lower high there, more or less matched it at 64. So if we get a rebound back towards these highs here, then a stop above 64 could set us up for a move down towards 62, 61. Okay, so I think that's pretty much it. Yogi, I don't know whether you want to come back in. I'd like to thank you all for taking time out of what's probably a very busy evening for all of you, and thank you for your time. And I hopefully you all found it very instructive.
And once again, Michael, thank you so much for having such an insightful session. Ladies and gentlemen, he was Mr. Michael Houston from CMC Markets UK, Chief Market Analyst, who just threw some light on what is happening right now around the world. Trading has been a bit of a roller coaster, actually a lot. But then going forward,